Hey guys, what's up? Hitori here. Welcome to episode 34 of the weekly market outlook with TradeXProp. In this episode, I'll be covering the DXY, US indices like the S&P 500, Nasdaq, Dow Jones, gold, oil, and also Bitcoin. If you have any other asset classes you would like me to cover, just leave a comment down below, or even better, join our free Discord channel where you can talk to me as well as the other TradeXProp team members. Alright, so getting into this week, let's take a look at what essentially happened a bit last week. So in the previous week, we saw NFP, right? We saw an addition of around 256,000 jobs, which is well above the expected 164,000 jobs. So actual numbers, they blew past the forecast, which indicates aggressive hiring. In fact, unemployment rates also dropped, confirming that this was indeed quite a robust NFP report. This will soon draw foreign investments into the US due to just the overall better returns, right? So when foreign investments get brought into a country, it strengthens many markets. It strengthens the currency because of supply demand. It strengthens stocks, and just everything just kind of goes up. So with this in mind, it kind of raises questions about the current rate cut strat or rate cut approach of the Fed. Okay, but we are now in almost the middle of January, and President-elect Trump's inauguration is pretty much just around like less than 10 days away. So there is some skepticism about how authentic the data presented is actually swirling up, because sometimes what these parties would do, now I'm not saying that this is what they're doing, but sometimes what would happen is that the President-elect's party would kind of swipe up a bit of data, trying to make it seem like, hey, when I'm in party, things are going great, things are going well. But that might not be the case. That might be the case. To be frank, we will never know, right? But regardless, we operate with the current data we have, and based on what we've just gone over, we know that the DXY right now is just hitting not all-time highs, but highs that we haven't been around quite since almost 2 years back. And this move right here is being confirmed by just how strong the US economy currently is, and it also isn't showing any signs of it slowing down. So it does kind of bring up questions on if the previous Fed rate cuts actually, last year's rate cuts, last year is like 2024, but if the Fed's rate cuts last year were actually enough to manage inflation, which is still above the targeted rate of 2% inflation. So that's something that we'll have to see as we go by, because when all of these kind of like investments comes in and all these stuff starts to blow up, inflation is going to increase due to how expensive the monetary scenario is in the US. So we'll see how it goes. We'll see how it goes. But speaking about rate cuts, FOMC projections in December. The FOMC meeting in December. It kind of suggests that we might be looking at a targeted interest rate of 4.25 to 4.5% for this year in 2025, with little expectations to for rate cuts. But like I said, we'll see once we get there. So yeah, that pretty much just bullish dollar all the way up. I'm not seeing any signs of it being kind of slowing down in a sense until we hit some major level. That might be the first sign that we could see some shift. But of course, I had to also kind of like reconsider what we're seeing fundamentally, but as of now, there's just no signs of anything in the US slowing down yet. Okay, I mean, the bond market, actually sees a 25% chance of no change in condition, but of course, market sentiment for the rate cuts, they kind of do lean towards some minimal cuts, if anything, which actually strengthens the dollar because people will now get a better return by just putting money into the dollar or just buying bonds. In fact, let's look at the 10-year Treasury bonds yield charts right here. Before we get to the DXY, let's look at this chart real quick. The strength in the DXY actually has its own implications. I mean, looking at the levels that we're currently at, we haven't reached these levels since April, right? And we're about to reach levels that we haven't reached since the inflation scare of October to November 2023. Currently, we're sitting at 4.75. Which could potentially translate into bad news for stocks, because higher yields on bonds, they technically become more attractive than your average equity just because of the risk to reward ratio. In a sense, putting it in bonds is a lot safer and you get quite a higher rate right here. Meanwhile, putting in equities like stocks, they do offer obviously a higher return, but with that added risk. Interestingly, as the Fed actually began cutting rates, we've seen yields not fall, but we've seen actually just had this bullish run higher. With unemployment ticking down as well, this has led to adjusted expectations for rate cuts, like I just said. With the bond market now actually betting on just potentially one cut by the year end. Right, with a 25% chance of no change, but the rest of it, people are betting on one cut, if any. Right now, could this potentially signal a cooling period for the market? Maybe. That's the question everyone seems to have in their minds. But quite frankly, I would just say that as we progress throughout the year and the quarters start to come down, we'll see. Right, we'll see. But as of now, probably minimal rate cuts for the year is the approach we should be seeing. All right, but anyway, let's just get to the DXY. So we know we're bullish on the dollar for all the reasons I just stated: NFP numbers, employment rates, strong economy, all that stuff. But technicals are also showing that we shouldn't be looking at any dollar bears as of now. We've just been pushing higher and higher, and any pullbacks have seemed to be great positions to enter in for a longer term macro move. So as of now, that still stands, right? We are currently at 109 right here. So we have just broken above this previous resistance of 109.25. If we do see a pullback down into this level, I wanted to reject it as a potential area to go long from, but failing to close and reject that level, I could see it coming down deeper into this previous leg right here, potentially even into this large area of support around 108.27 or 107.798 for a potential move higher, right? Looking left from where we currently are, we do have clean traffic supporting this move higher up into 110.549. I understand that, of course, we do have a potential, we do have this potential area of support broken becomes resistance, right? We have this support area right here, but until that happens, until we see a rejection beneath that level, I will not count it as support, right? Turn resistance. So I'll remove that, but if you do come down beneath it, sure, that's probably an area of resistance. But if you do come down, find support, the longer term macro move is still for dollar bulls to reach higher levels, right? This 110 level seems to be an easy one, I'll be completely honest with you, for us to reach right here. So I'm expecting us to actually come out to retest this larger trendline move with the first touch at around 112, right? So that's what I'm currently looking at for the DXY. Going back to the 10-year treasury yields, right here we are also seeing a similar picture, breaking above previous resistance at 4.708, closing strong bullish above it. Could see retest down into some of these areas for a potential move up higher into this problem zone for bulls around the 4.825% mark to 4.933% mark right there. Okay, so still bullish on the XY, still bullish on treasury yields. If we do break beneath some of these areas of supports, I would only see it as potential areas for pulling back into areas of value and then continuing going up, right? If we do break beneath 4.512% to 4.453% right here, that might be a problem. You know, that for me could signal some form of structure shift for a move downwards, cleaning this range right here. Okay, so it could potentially head all the way down into 4.148%, which is really low, cleaning out actually almost half of this bull move right here. Okay, so if we do break beneath that level, quite concerning, but you know, we will react once we actually, you know, get there. All right, so the XY, same thing. All right, if we do break beneath some of these structure points right here, I'd be concerned. I want price to hold above this level, 108.279, 107.798 for a push move higher. But if we do come down all the way down to 106 and break beneath it, I think we're going to head all the way down into 105, right? Based on just technicals, of course. So yeah, that's pretty much it for the DXY. Let's take a look at the indices right now. Let's look at the S&P first. So currently, on NFP day, we saw this large decline right here of around 1.4%. Everything pretty much dropped. If I look at the Nasdaq right here, it also dropped quite a lot. It dropped like 1.46%. The DowJones right here, US 30, also dropped quite a lot. I think these drops were mainly followed and caused due to just high interest rates overall, and also concerns about fewer rate cuts this year. Also, NFP showed just how strong the market was. So just looking back at the technicals right here, S&P has finally broken out of this huge range of around 200 points, right? 2,000 ticks. And this move lower on last Friday during NFP really signified that we are now closing beneath 5877, which is actually a key area of support. So now what we could see is we could see a potential retrace higher and a continued move down to clean this area right up. Because where we currently are, I'm not considering us shorting. You know, worst case scenario, you could enter on a low time frame, open high low close pullback. But I would like for price to kind of retest this value area right here and showcase that we are indeed going to be heading lower. Because if we don't hold beneath that area, we could see price faking us out, closing back above 5877, where I will likely see price come up to retest some of these highs right here at 5991, which also coincides with this trend line. Now, I don't normally implement trend lines, but if it's a good area that coincides with one of my horizontal areas, then definitely I put that in. But it's not something I use on a day-to-day basis, right? It's not the main point of my analysis. Okay, but looking at the S&P 500 charts, I think this one's cleaner compared to like the Dow Jones right here. we're coming into an area of support, but we are also breaking beneath an area of resistance, of support. So coming back, retesting, there's not really much width compared to the S&P 500. Here we have like around 500 points, right? Back down to this next area of support around 41814 to 41483. You compare that to also the Nasdaq, which is also, I think it's a bit cleaner. Oh, it's not even clean, sorry. It's not even cleaner, it's even worse. We have now reached an area of problems for shorts. Tap into it and have shown rejection. Yes, we have broken an area of support, but we've also reached a large area where we have a ton of wicks, which is just not clean. Compare that to what we saw previously on the S&P 500. There are some wicks here, sure, we've cleared some of them, but we also have a large clean area to continue fueling the move downwards for the S&P 500. Okay, this is around an expected 2% drop, around 120 points. So that's a better move in my opinion if you had to pick one for shorts. Okay, so looking at gold right here, moving on to my favorite pair, gold. Despite the dollar strength, we're actually not seeing gold prices tumble. The correlation actually isn't that strong if you look at, even though we are denoted in the US dollar. If the USD goes up, gold should in theory go down because gold is now a lot cheaper to buy. But no, we're climbing, and it just shows you that the correlation for commodities, in a sense, they aren't exactly as straightforward as Forex, right? So this isn't because of jobs data. It's kind of purely a geopolitical play right here. But gold has just been caught within this large range right here for like a very long time. It's been like, this is a, wow, this is like 1,000, almost 2,000 pip range right here. So as of now, we're breaking within this internal structure. Of course, we're breaking all of these highs and we're breaking them, closing really strong bullish. So I don't think there should be any reason for you to be looking at gold bears until we reach some of these levels at around 2718, forming a potential triple top. We could see price continue closing bullish until we reach that, and then coming lower. Or you could draw a trend line, which I don't do because I don't trade trend lines. I just use them as kind of like if it lines up, it lines up, right? But as of now, I'm still expecting gold to continue higher into these prices right here for a potential rejection. We do have this potential area that we could reject off of for longs. So technically this area right here would be a nice area to look at entries to get long on side off, right? But the issue is that if you break beneath this area, there really isn't any good shorting opportunities because we do have just this upward channel kind of. We have this support here, this wick to clear this support, and then finally this support down. Sure, you could be taking intraday plays, but then it's not really giving you that best risk reward ratio, and I just don't think it's a great idea, right? Depends on how we break this area. If we break it by a bit, we could consider taking shorts down to clear this wick, but if we close aggressively, taking out more than half that range, this play becomes invalid. The next area would be down here, but then again, it depends on the break and retest, if any, to clear this level right here. But as of now, just expect this area to hold for longs up into this area, which is around 600 points, right? So that's all good. Until gold breaks out of this range, I'm not looking at any long-term macro moves, so just playing internally within the range in itself. Okay. Alright, so let's look at oil next. So oil actually surged quite a bit on Friday. last week was a bullish week, and it mainly surged due to the new US sanctions on Russia, which might actually push inflation up if they don't control it properly, right? You can see that being reflected here on the charts. We just came up and we respected this previous resistance at 75.934. Depending on how we close further up, we should still be bullish because we just broke out of this horrendous range we've been in for months now. Actually, close to the elections, we have been ranging within this, and we should now be seeing a break, potential retest to continue higher, because normally when it's time that the election results come out, or actually a month or two before the elections and around that time period, parties would tend to try to keep oil prices low as a bargaining chip, saying, you know what, we've been keeping oil prices low for a long time. For the past few months, oil prices have been dropping. It's because of us. You should vote for us, right? So I think that this price area no longer has any value in itself. Of course, you could come down all the way here based on just how the global tensions are playing out. But as of now, this area for me should be revisited only for the purpose of pushing price higher. I'd be quite surprised if price comes into this area and then just starts ranging within it once again, but that could happen, right? If we are uncertain, that definitely could happen. I mean, uncertain in terms of how a war might be coming out, so that's something we should be looking at. So if we do continue pushing up, breaking above this area of resistance, we could see price heading higher into this problem area for longs around $78 to $79 per barrel. We could see an adverse reactions from there, but if we do come down and retest, I want to see price closing strong bullish at some of these areas for a potential move higher, right? So some of these areas right here is something you could be potentially looking at for price to revisit, come down into this area of previous accumulation, maybe wick it even, and then continue higher, closing above it, right, for potential moves higher. If we do break bearish beneath this level, then I want price to come back into some of these areas of accumulation for potential longs. Okay, so you could technically take short-term sells down into this area right here, but understand that it is nothing more than a potential short-term idea. Okay, so looking at the last pair for today, we have Bitcoin, right? I have the 120 mark pointed out right here in the previous forecast. We have reached this previous area of support at $91,000, 91k, and we have tried to, we have bounced off of it last week, but then we ultimately came back down into the level. I personally am expecting price to come back down all the way back into this range of 86 to 91k for some movement to bounce higher from. But if you do break beneath this area, definitely looking for a cleanup of this range to the left hand side down into 73k right here. Okay, but now we're just ranging right here. We definitely could see a deeper pullback in my opinion, right? This is just my first area of value entries for longs, but if it does break beneath 86k, I won't be surprised at all. We might be just clearing up some of the leftover orders around here before potentially climbing back up. Okay, still long-term bullish on Bitcoin as well as the entire crypto market, so I'll keep in mind maybe to add in more crypto pairs since we do offer crypto challenges here at TradeXProp. Okay, so yeah, that's pretty much it for this week. Do always manage risk, take care of your positions, take care of your accounts, and I'll see you all in the next one. Peace.